form exactly as the classical textbooks suggest. Now, why am I talking to you about dead German economists? Because ultimately this comes down, the question we're discussing today comes down to the degree to which policy can assume that we are all as individuals wholly utility maximizing rational individuals, and the amount of help that we need to achieve optimal outcomes in our allocative choices. I promise I won't use the word allocative again, because those of you who did economics at A-level will probably be having nightmares at this point. No more textbooks, I promise. So that's I think, from my point of view, the framing motif of this morning's conversation. It's also, I promise, the longest bit of talking you're going to hear from me in the next 54 minutes, because the panel are far more interesting and informed than I am on these issues. So with that, I am going to hand over to the panel. In running order, I think we hear from Hilary first, followed by Peter, and then finally from Nigel, who's here in his guise as chair of the APPG on pensions and also a member of the Working Pensions Select Committee. But first of all, we'll hear from Hilary, who is known on Twitter as Red Actuary, which I think that's a football thing, not a political thing.
A little bit more.
I don't claim to know anything about either football or politics, so that's I'll leave it there. But, Hilary,
Thanks, James. Thank you, and thanks everybody for joining us for this discussion. I thought I should perhaps first say a few words about the Institute and Faculty of Actuaries. I know we have some experts in the room, but some people might not be quite so familiar with us. So we are the Royal Chartered professional body that represents and regulates 32,000 actuaries, not just here in the UK, but worldwide. We oversee the education of actuaries and provide CPD opportunities to support our members' lifelong learning. And we're really keen to fulfil our public interest duty by supporting and contributing to debate and discussion in areas where the analysis that actuaries can provide is helpful. And our project on the Great Risk Transfer is one area where we think our technical knowledge and insight can really shed light. We're delighted to be promoting this debate around this whole area here at the Conservative Party conference. Our members work across the whole areas that the risk transfer, the Great Risk Transfer Report work considers. So from pensions, which is the area that I work in, and I will admit upfront that I will be pensions heavy today, but also insurance, investment, regulation, and indeed within government. So if you read our report, I think you get a real feel for the real breadth of knowledge that our members brought to it. But it also, I think, introduces some of the tensions that there inevitably are between ensuring customers are adequately protected and making products that are so risk-free that they become unaffordable or difficult for people to access. So on to the report and to say a few words about it. And it's worth saying that I think it's important not to see insurance and pensions and the areas we work in as isolated from the rest of political society. And I think there have been wider social changes that have affected some of these issues. So they're not just technical issues, they are also technical issues, but they're also social and political issues. So I think we've seen over the past probably 4 decades now a shift away from collective ways of resolving problems to more individual ways of resolving problems, and also a redefinition of risk away from what it would once have been, which is a fairly neutral term. There's good risks and bad risks, to something that's viewed as a universally bad thing. And if society views risk as bad, then it's almost inevitable that will involve a shift of risk away from the less powerful, away from the powerful and towards the less powerful. So what does that mean in the real world? That all sounds very wordy and perhaps not easy to grasp. So if we look at a couple of examples of what this means in the real world, I think that does bring it to life a little. And the example I'm closest to in my work is the move away from good quality defined benefit pension schemes to individual defined contribution schemes where members take on not just the investment risk, but unless they buy an annuity, also the longevity risk. So defined benefit schemes are now almost entirely a public service thing, but there's now around about 1 million members in the private sector in DB schemes where, you know, benefits are still building up. Previously that was, you know, 11, 12 million, so it's a massive shift. So that's one example. Another example of the risk transfer is in general insurance, where I think the trends I've already outlined, but if you add into that the availability of data, much more data is available, and we have lots more techniques and models in which to use that data that allows risk to be assessed at a much more granular level, much more individual level. And of course that works really well for those people who are low risk, who benefit from low premiums, but it doesn't work too well for those people who need insurance and are perhaps priced out of it. You know, they're perhaps the people who most need that insurance. So, you know, what are the things that we can do about this? And our report identifies 2 challenges. First of all, how to rebalance some of that risk back away from individuals. And secondly, to give individuals some of the tools that they might need and might use to manage that risk better. So again, you know, concrete examples, what does that mean in the real world? And the first example I would raise is the introduction of collective defined contribution schemes, CDC pension schemes, that can provide a reliable but not guaranteed income in retirement. And do note that CDC schemes are a way in which members can share the risk between themselves in a collective way. They don't involve the transfer of that risk back to the employer, although in the current legislative framework, at least initially, they will need an employer to back them, to allow them to be set up. And secondly, we've recommended that government consider the introduction of default decumulation pathways as a kind of safe harbour for those people who need to convert a DC pot into a wage in retirement. So you can look at the kind of objectives that people need to meet in their retirement years and signpost some appropriate products that will meet those objectives. That recommendation sits alongside some others in this arena, which I won't talk about at length, but just to whiz through them. An aim to significantly increase the extent to which people take up their opportunity to have a pension-wise appointment. The need to show pensions income in a kind of reliable and consistent way in the pension dashboard, but more widely in other benefit statements. And more public messaging on the need for adequate provision for retirement if people are to enjoy the kind of retirement they perhaps envisage. We really welcome debate and discussion and challenge on those recommendations, and really look forward to that debate starting here. Thank you.
Thank you very much. I'm not sure we will. I can pretty much guarantee you we will be having a debate about accumulation pathways, and nudges and all the rest. But I'm going to hand over next to Peter Tutton from the StepChange Debt Charity, who will come up to a similar question, possibly from a different point in the income scale, I suspect, but with possibly some similar and contrasting thoughts. Peter.
Thank you. Hello, everyone, and thank you for inviting me. And if anyone's got a chance to read both this report, the Great Risk Transfer, and the insurance one that has just come out, give them a read. They're both really good reports. I'm not at all an expert on pensions, so I spend my life as a debt charity thinking about people whose household finances are in crisis point and have, de-accumulated, as it were, through debt rather than building up pension savings. But it's not a bad place to start, actually, sort of not being an expert. Because of my job, I'm someone who I'd like to think has slightly better than average understanding of how financial products and markets work. I'm approaching 55, so I'm right in the mosh pit of all of this. Do I understand my pension options? No. Am I confused by it? Yes. Am I getting increasingly a little bit scared as it rushes towards me? Yes. So I think that's not a bad place to start. So thinking about our clients, people who are experiencing financial difficulty, may have spent a large part of their working lives struggling to make ends meet, uncertain incomes. What does this mean in terms of policy to ensure those people get an adequate and secure retirement income, which really, I guess, is the policy outcome we all want from this, that people have a secure income in retirement. I'm sure people would have seen the sort of rather gloomy PPI predictions on the number of people, proportion of people who are coming up to retirement who won't have adequate savings and are likely to run out of money after a couple of years from what they have in their current pension pots. So what does that say going forward? We have a growing cohort of lower income pension savings because of auto enrolment, which is a good thing, more people saving, but are they saving adequately? Many not, a bad thing. So what does that mean? One of the things to think about here is kind of some of this group of lower income savers will look very much like the group of people at the moment we see who have low financial resilience and high vulnerability to debt. The work from people like the FCA, their Financial Life Survey, shows that with COVID, that group has only grown. They estimate there's now 14 million people with low financial resilience. So, for instance, the definition of that you couldn't stand 3 months worth of bills if your main source of income fell. And over 23 million people are unable to do that, but also borrowing in a way that looks unsustainable. So real challenges to this group in terms of building up a savings position, given where they are. And in that group, lots of younger adults, the people who need to be saving now to maximise their chances of an adequate retirement income. Now that looks very much like the group of people that we've been seeing for the last decade or more in debt advice. It also looks like the people who've been disproportionately hit by COVID as well. So there's some real challenges building up, and some things I think when we think about policy in this is go back to that first principle of how do we maximise the chances of these financially vulnerable group of people getting to retirement with something to live on. What are the sort of risks that people face in this situation? Well, firstly, there's the constant risk of financial difficulty and problem debt. There's been a lot of talk with COVID that a group of, say, 50-something employees may be difficult out of the labour market and find it difficult to get back in again. And certainly the people we see, this risk of financial difficulty and problem debt. So the tensions between saving and managing for now are apparent. The risk to adequate savings generally, as well as pension saving, the risk to build up the challenge of building rainy day savings, precautionary savings, so the sort of good work of the Help to Save scheme and pushing that out further. Many may approach pension freedoms under financial pressure. So when pension freedoms happen, for us as debt advisors, the kind of tension of people, do you use your assets now? Do you draw down to deal with your debts or don't you? And actually, in some respects, how possibly those assets could also come under attack from, used by creditors can try and get after them. So again, a tension between dealing with where you are now and thinking about the future, which of course raises a question also of scams, of poor decisions, and people having to use their retirement savings up. People under financial pressure often don't make good decisions. And if they've not got much to play with, the kind of issues about how to maximise that and the kind of decisions that are frightening me at the moment is even more important. There are other things, complex interactions with the benefit system, with things like pension freedom. So, and wondering when we get more people, say, in older age groups who are coming towards retirement or in retirement in the private rented sector, where they have higher housing costs, how does that work and what's the interaction potentially with the benefit system there? Is the pension market well set up to deal with financially vulnerable consumers? It's full of complex choices at every stage along. They don't seem to go away from which pension, how you do it, how much do you contribute, what do you do when you come to pension time, how do you, these are all really difficult choices. And consumers don't necessarily deal well with complexity. I mean, we know that from lots of different places. Guidance, advice all help, obviously, but to illustrate the sort of difficulty of this, I was looking on the Money Helper page on pension guidance, and it says, this is what it says. It says, you need to carefully plan how much income you can afford to take under pension drawdowns. Otherwise, there's a risk you'll run out of money. This could happen if you live longer than you were planned for. You take out too much, so your investments don't perform as well as you would expect. So think of 3 risks there. Thinking about how long you're going to live, that's a bit tricky. Thinking about how much money you need and, unexpected expenses and all the rest of it, and investment risk. That's a lot for someone with a small pension pot or low income to think about. Advice is really important, clearly, but is this a group that is going to be accessed kind of independent financial advice? Traditionally not. Will they be able to access it? Will they be able to afford it? Will they be able to comprehend it and act on it? These are all things we've seen before with sort of, people entering financial services with markets, credits, other things where people have ended up getting bad deals, whether on advice or a broker or otherwise, simply because kind of can comprehend this stuff, and the way it's presented to people isn't really necessarily the way set up in a way that people can understand. A good example of that might be, say, if you remember child trust funds, a great idea of a policy to try and get lower income households kind of thinking about financial needs and investments. And the big thing that came out of that, one of the big things, that lower income households were all going into the default trust fund. And the government produced a fantastic set of advice tools. I was working in Citizens Advice then, and Citizens Advice Bureau staff were kind of working people with that. But what they were saying is, we go through it all with them, and when it comes to they have to actually go down to the high street and choose one, they can't do it, because that's sort of really difficult and paralysing choice. So have to think about that as well, is what's the translation between advice and people actually getting an outcome at the end of it. The FCA found in their retirement outcomes review, perhaps not surprisingly, that the market isn't necessarily working always well for consumers. Competition's not great, little pressure, low switching, opaque charges. This is something that we see repeatedly in financial services markets, and kind of overdrafts to other things as well. So these problems that we have for consumers of retail financial services about the market not necessarily working in their in a way that's good for them, and we see it in other markets like fuel, which is topical at the moment, where the people who are on the higher tariffs tend to be the ones who are less able to engage with the market, or what's now called loyalty premium, and they to engage. So all these things line up. If you have your wellbeing outcomes are heavily based on making well-informed choices, there are barriers there for those households that most need to get the most of their pension. So what can be done? Simplifying products and de-risking. So your CDC idea seems to be a really good one. Two things there. One, there's a process going on in financial services, this idea of consumer duty, which is all about how providers focus on good consumer outcomes. So what would that look like for the cohort of lower income auto-enrolment pension savers? What would a route for somebody who's 25 through to into retirement and beyond look like for those people, and are we there now? Secondly, I mean, one of the interesting things on the CDC, one of the things that something that's very strong in these reports is two conceptions of fairness. So one conception of fairness, which is about individuals getting the best price, in terms of risk based pricing, so that you use the risk pool, you cut the risk pool so that each consumer gets the best price. But then another conception of fairness, which is ensuring everyone gets a level of service and outcomes from those financial products, which is socially acceptable. And I think what you're talking about cuts to the heart of that. It's difficult, but that's really where the debate is. I think that's me.
Thank you very much, Peter. I'll add that to my seminar question here list later on about the equity of price discrimination, which is another good undergraduate economics topic. So questions will be asked later. I will hand over now to Nigel Mills for the magisterial parliamentary upsum of the history and future of risk and personal responsibility in pensions and other financial services.
That's a challenge, James. We're a bit more than 5 minutes for some of that. But
it takes 6.
You're too kind. I mean, I think where you started was, can you assume that people are going to take the rational, well-informed decision to get themselves the best possible outcome? I think given we've had huge success on pensions by auto-enrolling 10 million people, and we've had that success by hoping that they don't notice. And it's kind of hard to believe that at some point you can then switch them to being highly engaged, highly informed in a very complex situation. They're able to choose the right outcome for themselves. And so I think we just have to kind of accept in pensions that we probably can't get the engagement level to where we want it to be, and we can't build solutions around if only we could achieve that, everything will be fine, because it probably won't. I think actually that's even slightly worse. People just don't value the pension contribution their employer pays them. I mean, you hear stories of people moving jobs for 50p an hour and giving away 5% pension contribution for it. And I think that's one of the challenges we have in a labour market like we currently have, is if we want employers to become bit more back into that space and kind of like look after their employees' long-term well-being. How do we get employees to value what their employers might try and do for them? And I think there probably is an opportunity now, given lots of employers are now having sort of labour scarcity and need to find ways of retaining the good people they've got. But actually, we could have a chance of some more investment into pension schemes if they were valued as a way of keeping people. But otherwise, that real risk that Hilary set out, that people just aren't saving enough, anywhere near enough, is going to be the impossible one to fix. And we can look at all manner of clever ways of people cutting the cake better when they get to retirement. But if the cake, rather than being wedding cake size, is Mr. Kipling country slice size, they're going to be able to slice it as best they can. It's still going to be a few crumbs a year. So that is the urgent problem. I think when we were sat at a party conference here 2 years ago, we probably all have said, autumn ones work, very low opt-out rates. Let's get the contribution rates up to near the 12% where we think they at least ought to be. I'm not sure, hand on heart, we can sit here today and say that, because that 4% out of the wage pots that we would be taking for that, well, the government have just taken 2.5% on national insurance rises, and with higher cost of living or economic damage we've had, hand on heart, can we really think we want to take 4% out of people's pay and they'll be happy with that? I don't think there's any prospect the government will be looking at that this side of the general election. So you're pushing it well into the mid to late 2020s before you probably have even thought about that. So how we increase saving rates by engaging with people and convincing them that's the right thing to do, I think becomes more and more key, because the government, I suspect, won't be riding to the rescue on that, important as it probably is. So that leaves us with the other risks of how do we get people the right outcomes once they start thinking about these things. And we clearly do need to try and intervene on people before they get to the state pension age and say, here's what you could have won if only you'd saved a bit more. I think I remember Bullseye from all those years ago. So we need to find a way when people have got some time to change things, to explain to them what they need and how far they are away from it. I think that's where the minister's very keen idea on the midlife MOT would be a good thing. I'm slightly nervous that that's becoming sending people some links to some stuff on the Money and Pension Service website rather than an actual intervention to make them think about their financial position, which I think is where we started that discussion. Presumably the Treasury boffins have looked at the cost and thought writing people with a few links is a lot cheaper than giving them an hour session with somebody. I think that how we get that information into them while they've got the time. I mean, clearly the pensions dashboard can have a role there. It does need to get to where people look for their finances. I'm not convinced that having a pensions dashboard somewhere in the ether that I get sent a link to at some point is going to change my behaviour, unless it's somewhere there when I go and check my bank account. I can scroll onto my pension tab and see what I've got, and it tells me, you said you wanted to get this and you've now got this, you need to do something. I think that's how you get the engagement in saving in that situation, rather than just thinking some nice thing sat somewhere and get looked at very much. Pension-wise, the Select Committee, we've been trying this for a long time. We've got an excellent service that gets wonderful feedback, doesn't get the take-up we need. We do need, I think, to find a way of getting very many more people. I don't just mean a few more. I mean, we need to get sort of half the people who are retiring who aren't taking advice and have got anything remotely like a sizable pension pot, just to have that intervention to get some understanding of what their options are, so they don't make the wrong choice. And that's finally CDC. I mean, I have a vision that we don't need CDCs to be employer links. They ought to be there as a decumulation choice that a saver could make. You could have a master trust option. You could perhaps link them to the big master trust. So if I choose to want some risk pooling and a collective option that might get me a bit more pension, if I'm the lucky one that lives a long time, not the unlucky one that doesn't, that's a kind of like a halfway house between an annuity, which just still look pretty bad value to a lot of people, and just relying purely on drawdown. If we could find a well-regulated and good quality way of achieving that, that might be one way of slightly bridging the gap. I get a little nervous as a politician when you look at a product and think, well, the only reason that's not an annuity is because we regulate it a bit less. And there's a sort of a promise that's really a promise but not certainty, and it then gets sold as a certainty, and then people think it's certain and it actually turns out not to be, and then we realise we didn't regulate it very well. We'll be quite careful how you market collective risk, because what we mean is those that die quickly pay for those that live a long time. Not everybody kind of understands that's what collective means in that situation. They see the higher pension rates, not the downsides. But I think that's probably where we could find some sort of advantage, unless we really believe defined benefit pensions are coming back. And I think I would be optimistic too.
We like optimism, but not possibly practical optimism. Thank you very much, and thank you all of you. Before I do go to questions from our audience, can I ask a question really inspired by Peter and his current, I was going to say plight, that seems a bit harsh, but Peter and his current consideration of approaching Freedom Date. Just curious to get you all to expand. You touched on it with midlife MOT, I think. Obviously, it's in some ways it's too late for Peter because he's very close to the point of that freedom where he will have to make his big important choices. Possibly,
Sounds like I'm heading to my grave.
You had a good run. But the question is are we leaving it collectively too late to intervene, to provide information, guidance, advice, to help inform better choices for Peter when he hits 55? And if we are leaving it too late, what more can we do? We've heard a little bit about midlife MOT, other interventions that should be considered at an earlier stage in the process. Hilary, can I jump on you? Can you get take that first, and then maybe more from Nigel there, and then we can have a final valedictory word from Peter before he shuffles off into his freedoms.
Yes, so I would say that I absolutely agree that just intervening to provide people with financial education and guidance at retirement is too late. And it is something that needs to happen frequently. And, some of the big employers are really good at this. We work with a number of employers providing financial education regularly throughout an employee's career, particularly at stages, where they have things that change in their personal life or in their career at work. So I absolutely agree with all that. And I do think there's an extent to which employers need to step up to the mark a bit more here. So they've kind of shuffled all the risk off onto employees, but not necessarily providing some of the tools that employees need to help them do that. And I think it's a very personal thing. Personally, I think face-to-face works. Face-to-face advice and guidance is what people need. I'm not sure that they just need tools. I think tools help, but I think face-to-face is actually much better. But I think the other point I would make is that as a pensions industry, at the moment, we find it very difficult to provide pensions. And that's not great. That's not a great reflection on our industry. So, we need to do better. Nobody says to me, Hilary, you need to engage a lot more with your car. You need to understand how it works. You need to go on a course to understand how it works. I just need my car to work. For most working people, they just need their pension to work. They don't need to engage with it. And I think you're right, Peter, when you say they won't engage with it frequently and with gusto. So we need to provide them with something that works better. And I think CDC is one of the vehicles that will do that, not for everybody, but for a large proportion of the population. I think that could be a real improvement, particularly if you get the kind of products that Nigel was mentioning, where you could have a drawdown product to CDC. So the Master Trust could provide it, and it's not necessarily linked to your employment.
Oh, thank you. Nigel, actually, you heard from me a little bit about midlife MOT and also with your CDC, but away from the sort of that significant chunky reform, are there tweaks that can be made earlier in the life cycle as things stand to mean that people reach that point of 55 better informed, better supported, better advised, better guided?
I think the challenges we probably need as a public policy to have a consistent saving message for what we want people to do. Because we start taking, as soon as you hit 21, we start taking money off you to put in your pension. We're just going to save you on the housing ladder. I'm never entirely sure that's quite the right idea. That maybe we should find some way of having a sort of like a saving mechanism that once you've got yourself on the housing ladder, you then start saving for a pension. And people can then get to use and trust savings, so they've got the pot of money in case the car or the boiler breaks. They've got themselves on the housing ladder if put them in that position, and then they're saving for their pension, rather than have these things competing and people sort of like having to choose which thing they save for all the time. And then people may well then perhaps feel that this thing works for them better and engage with it a bit more. I'm not sure you can educate people in their 20s on pensions and they'll remember it. And even if they did, that actually necessarily that's the right choice for them. It may be for some, and the earlier you start saving, the better. So you have to intervene, I think, at the time when people still have a chance to change their outcome, but are starting to think about it, which I guess is sometime around your mid-40s rather than your mid-20s. It's why I think actually people are engaged with their finances, and actually generally the less money you have, the more engaged with them you are. And people are using banking apps and all manner of tools out there that didn't used to exist. So I think there are ways of getting that information to people if it can be presented clearly and sort of like show them, by your age, most people have saved X in their pension. You've got Y. You need to think about that. That's that sort of thing. I think could be clearly understood, and not be telling them that the forecast income rate from their pension pot is 3.73%, and therefore they're going to get £2.73 a week. I mean, you don't need that. You'd say people have saved 50 grand, you'd say 30. You need to save a bit more. That kind of messaging, I think, would help people engage with it.
I think you raise an interesting point about conversations, intentions in policy around saving. In the context of this conversation, I have heard it suggested in Whitehall that there is a slight difference in view between DWP and Treasury about whether or not people ought to be managing their pension savings sensibly, the DWP view, or spending them on new kitchens and Lamborghinis, and therefore stimulating the economy through demand. The Treasury view, but I stress that's a scurrilous rumour put to be by an anonymous source. So you thread in the conversation. Peter, what would have helped you reach you?
I mean, I'm not quite the sad case I painted, in so much that I can and will ring pension-wise, excellent service. I can afford to get some financial advice, so I will muddle my way through it. But I think what it shows is that people don't tend to approach and think hard about these complicated and sort of significant choices about finances until they have to. It's hard to do. So doing a bit early would be good. How we encourage people. I mean, there's some questions about the kind of I get communications from my pensions, and I know they're actually quite hard to understand. And this is an ongoing kind of. If you were starting from scratch and saying, assume, that your customer is a low-income person with very little experience of financial services other than through auto enrolment, then what would your comm strategy look like? I think it probably look very different than what it does now. So that's one point. I mean, the kind of more general point about savings, I think it's a good one. It is hard to get people to think about pensions in their 20s. And of course, they're under different financial pressures. I can remember a younger colleague asking about what do they do on pension saving and afford their student loan repayment. So there's real world pressures out there, and that's a harder set of questions. So if we want people to save adequately, some of that is about behavioural change, but some of it is about means to do it, which is also quite a hard question. So the long and the short of that is agree with both. Yes, do more early, but be realistic that people may not engage. And actually, in terms of understanding pensions, when people get into their sort of 40s and 50s, you probably get a better strike rate.
Thank you. Now, I'm going to go to the audience. I may you can turn on the audience to actually ask some questions of you. So I don't know if you've got some from the industry here. I'm very interested about that communications point about how the industry can actually effectively communicate with customers, because I suspect some of you might point out that the degree of regulatory requirements you have to meet in communications renders clear communication quite tricky. But I don't want to put words in your mouths. I'm going to go to Ben Stafford first, who's raised a hand. Ben Stafford, who are you, Ben Stafford?
Thank you, James. I'm Ben Stafford. I work for a specialist retirement provider called Just Group. Peter, you mentioned that you were in the mosh pit as you approach 55, which is not an expression I expect to hear much in the next 48 hours. You're not alone. There are hundreds of thousands of people like you each year who are coming to that point and do make decisions about accessing their pensions and the freedoms. And most of them don't get regulated advice. I know the IFOA have done some great work on this, and I'd be interested in your thoughts on learning from auto enrolment and a non-mandatory approach to actually also enrol people into services that we know to have a good positive impact on people, so that they know those pieces of information that can be so valuable, and quite a few people only actually find out how valuable they are once they've made a bad decision.
You're asking whether or not we should be, there should be even stronger nudges towards towards advice, is that?
It's a bit more than that, James. Auto enrolment is not a nudge.
No, well,
it's a decision by policy to recognise that people actually were resistant to nudges, and so the idea was they'd be put into a flight path that took people in with the option to go out. And
yes, I guess I'm being euphemistic. A firm shove into advice. So, thoughts on who wants to go first on shoves, nudges, pushes, and I don't know.
Yeah, I think it's clear that the take-up of pension-wise is far, far too low. I mean, it was created when we introduced the pensions freedoms with the idea that, the majority of people would take it up, not, 14% if we get lucky and the nudge works. I think there is a big step in that needed. So I would agree with Ben's suggestions, like he's been pushing for this, that we have some kind of mechanism where when you're approaching a certain age, we send you an appointment at 6:30, 3 Thursdays time, and you can change it on our website if you want to go and change it, or you can cancel if you do. But there's some kind of prompt to say, look, you've got a decision point coming. Yes, you
have to make an active choice to opt out of that.
Yeah, and I'm sure that they could run it like BA on their flights, and you're overbooked. Some people just won't turn up in that situation. I think that's something the regulator should trial with some. I'm sure there'll be a couple of pension schemes out there be willing to put their members through it. You would probably want some kind of release code once you've done the session, so you could say, I've had this now, I can access my pension, and without that release code, perhaps they just send you back and try and get that. So you wouldn't make it mandatory, but the old saying, credit available if you bring both your grandparents and they sign in blood or something. That kind of, we need to try and say, well, it's an hour, it's 3 weeks' time, it'll be really useful. Actually, you really should do this before you make a life-changing decision.
Thank you. Hilary.
And I think some big employers could do that in the workplace. There's no reason why that couldn't be done, and that is the place where you find workers, in the workplace, and trying to get them somewhere else is always a bit of a barrier that makes things a bit more difficult. And the other thing I would perhaps just raise is that at the moment there are still some barriers to employers providing more than very basic advice because of the benefit in kind taxation issues. So I think if employers were able to do more, some employers would, not all employers would. And I do think that some of these things need to be on, the bargaining agenda of trade unions. They should be saying, this is what we want employers to be providing for our employees. If you won't provide a DB scheme, which most employers won't these days, then provide some access to workers to put them in a position where they can help themselves.
Thank you. And I think that's a very good point. We get on to that and talk about the cultural transformation required to get people, when choosing jobs, to think more about their pensions, which is a very important point. But Peter, Peter thoughts on nudges, shoves, pushes for people on lower incomes particularly?
Yeah, two things spring to mind. One is an example from the fuel market that's been going on, where there's been these trials of opt-in and switching. So again, the way the fuel market, you all these tariffs, and your savvy shopper, you go around, you get a better deal. And we know that millions of people, particularly lower income, get left behind. So take approach where that more proactive approach, where you are invited to join a sort of opt-in scheme. The route to kind of choosing your best option is simplified. There's maybe a trade-off there that you may not get the very worst deal, but you'll get a better deal than the one you're getting at the other. I don't know quite how that translates into pensions, but it's a bit like kind of you're talking about is a sort of, something that hedges the risk. It's not fabulous for everyone, but it's good for everyone. And a bit of a helping hand to get you through it. And what those trials found is they got massively better engagement. So people who had been stuck on default tariffs started getting better tariffs. So I think there's a lot to be said about really thinking about a strategy for active participation, reaching out to people and offering a simplified process and a better explained process to get in. The only thing I'll say on this employers is a really good point. And auto-enrolment does offer some opportunities, and if employers are incentivised to do this, to think more generally about financial health. So as well as pension savings, there are things like short-term saving. There's an excellent thing that Next Insight are running called the Sidecars Project, which StepChange is a sidecar employer, and that's about workplace savings. Whilst people that are asking for work saving through your through payroll. In the future, that may be something that could all be bundled into auto-enrolment, so you could build up a bit of a precautionary part, and Workplace Pension Policy Institute showed that that may actually stop people dropping out in the hard times. So there's things that can be done.
Although it's politically tricky at the time when there is pressure on the cost of living. I'll lay at the back corner first, and then, so in running order, lay it there, and then I'll come here and here. If we got time, we'll see where we go from there. So yeah, lay at the back. So we don't have microphones, so you just speak up.
I am 36 and I am on my 6th pension from auto-enrolment. What other financial product would you allow your employer to choose for you? What other, are we going into, are we starting a new job and your employer saying, we only offer bank pay into HSBC, so your bank is now HSBC. And it doesn't matter about your other bank account that you had in your last employer. We're not living in the age now where we all queue up on a Friday afternoon and get our wages in a little brown envelope. We've all got bank accounts. Payrolls are done by a computer. They're all auto-enrolled. Why can I, as somebody who is reasonably financially savvy, not bring my pension pot that I choose for myself to my employer and say, here's my pension, pay into it. And the second time point, I looked for pension advice in my late 20s, couldn't find any. The only person who was able to explain to me what pensions I had and what they were and how they worked was Adam Shaw off BBC Moneybox, because I replied to a tweet to say, I'm millennial and I don't know what I'm doing with pensions.
So, so where can we get better, more accessible advice for younger people, and essentially why can't you just port a 401k around between jobs? I'm just curious, your 6 pensions sort of enrolment, they can't all be with different providers. Surely some of them must have ended up with must be with you must have an overlap with Nest somewhere there.
I think there's 2 on the same one.
Okay. Thank you.
But I've also got a pension as well that my mother put some of my dad's life insurance money into as a tax dodge on the gun ground. That was the one that had insurance claim on it, that had no claim.
Good. So you're right. A case study for the small pots problem. Nigel, tax dodges, small pots, and advice from millennials. Where would you like to start?
Don't give your name for it.
Tax planning.
Yeah, I think on the multiple pots, and that is a solution we need to come back to. I think Steve Webb had his pot follows member, so the money sort of follows you to your new employer's pot. Up to a certain level, that makes sense. Or you could choose a consolidated pot is kind of the other option. I mean, you can't be beyond the wit of man for large employers running big payrolls just to be able to choose which one of the main auto-enrolment pensions your money gets sent to. I guess there's a limit to how many they could cope with, but there's no reason they couldn't cope with all the big ones. So
why do you cope with bank account?
Yeah, but I'm not sure if you had your pension in a tiny former employer one that they could necessarily find an easy way of sending the money to it, and there are sort of like thousands and thousands and thousands of pension schemes out there that in theory you could choose to. So I think having that sort of platform approach for large employers could work. I think there's a need on the auto-enrolment to move from a market where they're trying to be cheap and easy for employers to be trying to give good pensions to savers and employees, and that what they should be marketing themselves on there, who can give the best pension, returning the best service to people, not be the easiest to use, which I'm not sure we've quite got to yet. So I think there is a role for government regulator to try and find that solution for small pots. I think even enabling them to do a bit of pots swapping, blind dating kind of thing, so the pension schemes can move around the really small ones and try and take this problem away. Because if what you want is engagement, people need to have a pot of a decent size of money and not so many they can lose control of it.
Thank you. Hilary, Peter, pot follows member, small pots. pot swapping?
I mean, just preface this with saying I'm not giving you financial advice. So-
That's not the problem, is it?
That is the
Guys,
problem.
Exactly
I'm going to come on to that. Yeah.
Guidance?
But guidance. So, but there's nothing to stop you transferring all those pots into one pot. You know,
But then my
your
employer wouldn't
intervention.
carry on paying money into that, I just sit there.
No, but you know, you can bring them with you as you move from employer to employer. Bring them all into your new employer's arrangement. So you can do that. There's nothing to stop you doing that. I think the bigger problem is probably this issue around advice and guidance. And I keep saying we've got to kind of reclaim this word advice, because everybody's terrified of giving advice because they've been drummed into their heads that that's regulated. You'll be sued, and you'll be, you have to pay a load of money to people. Actually, you know, giving people advice and guidance that's not regulated advice is something that we should be, you know, much more willing to do. If I ask you how do I get from here to Leeds, you won't say, oh, I can't advise you on that because that's regulated advice. You know, we need to get to a better position where we can say to people, of course you can say to people, you can transfer pots in. Of course you can say to people, you know, that there's this product that your employer provides, that these are the pros and cons of it. So we need to make it much clearer that advice is possible, and where the kind of dividing line is between that and regulated advice. And I think we need to, as an industry, be a bit braver about doing that, really. IFA, finding IFAs is a real problem, not just for young people. There's a real lack of trust of IFAs. There's a shortage of IFAs who know enough, particularly for the kind of people Peter was talking about, where there is that really complex interaction between benefit system and drawing down and pension benefits. And there's also a complex interaction with social care. And I think having a clearer view of the social care position, almost whatever that view is, you know, is better. So I think that's a step forward. I don't know how we solve the IFA problem, because, you know, partly it is an issue that there has been so many issues around advice that now it's almost impossible for IFAs to get indemnity cover. So masses of them are just leaving the market. So it's getting worse, not better. And I don't know how we resolve that, really.
Thank you. Peter, any thoughts on pots? And I think I'll do a round of questions. I'll do three questions in one go, and you to try and cram us all into the last 6 minutes. So Peter and pots.
Nigel's hit it on the head, really. You know, moving from what is easy for employers to what's good for savers and consumers is a shift that has to happen now. Can't start from where we are now, but looking forward, that would be one of the things that would be a change. I agree with Hilary as well. The problem of kind of this advice guidance that hits us when pension freedoms came in. So people coming to us saying, "I've got debt problems. Should I exercise my pension freedoms?" Created an enormous kind of regulatory and knowledge boundary. And there are two bits to that: is understanding everyone's terrified. Are we going to end up falling foul of the FCA by saying the wrong thing? Well, that's a relatively trivial thing to deal with. But two, do we have the knowledge framework to give people the guidance? As an advice, it's not our specialism, so how do we do that? But then three, the referral route. How do we, it's a bit like the Child Trust Fund, we can tell people exactly what all these different things are, but actually people then need to be led to, and that kind of referral route, particularly when IFAs are hard to find, etc. And that seems to need some sort of more structured solution than, but I'm not quite sure what it is. It's how do we encourage that?
Thank you. Now we do have 6 minutes left, and we have a very hard stop on this event at 12. So I'm going to try. I'll go. There's three of them. Gentlemen here, here, and here. If you all have brief, crisp questions, and then even crisper answers from you.
Julian Ellicott. I'm Chief Actuary of the National Friendly Society. So my question is very much about to what extent has consolidation in financial services contributed to the problems, especially small, locally based, employer, occupational based friendly societies, building societies. Essentially, have we been regulated out of existence? Solvency II, etc.
Is biggest the problem here?
Yeah, and then you're just left with computer says no, big companies.
Gentlemen there.
Okay, just one point here. We're all living longer, by the way, which is good news. Freedom is only the beginning, not the minimum. That's the minimum, not the maximum. My question, though, I thought Nigel spoke a huge amount of good sense. We have a blunt, also around what you say, blunt tool. What we should be doing, or my question is, should we be doing a much more nuanced basis, i.e. don't pay any money in auto enrolment, or give them an option of 0 to 4% in your early years. You're paying off mortgages, you're paying off your debt, trying to get on starting your housing ladder. But when you're in your 40s and 50s, give people the option to have a minimum of 6% and then 10. In other words, flex it according to how your life is. As you get older, you generally earn more.
Thank you. And last question.
Yeah. So I set up National Unity as an independent charity in 2012. The assumption that we're building this edifice on is just completely wrong. Half of adults have primary school level number understanding. I set up play numbers in January this year. I've been working with the Bank of England and 5 companies. We've shown that we can help companies communicate numbers and data more clearly. We've doubled levels of understanding, but there is still a huge gulf in terms of the assumption that we're making about people and their actual capacity, and then you overlay behavioural science onto that, and we just need to start again. So we need to check understanding. I would contend we need to check whether people understand their financial freedoms rather than assume they do and pick up the pieces later.
Thank you. Now, with 4 minutes left, I get thoughts. I'll turn to Peter. Would like your first name? You pick and choose whether bigness.
Well, I mean, so I have dealings with credit unions, and it's a similar thing in credit. Is how do we? So I understand what you're saying, that, and kind of agree. How do we make sure the kind of say the mutual and smaller providers who are maybe more socially focused, dare I say, are able to flourish, and that's a good and ongoing point. The age flip one's an interesting point. You know, how do we? But it's an element of that anyway. But yeah, I mean, there's a sort of realism of when are people best placed to be able to save for retirement. I mean, we're having things like kind of is the way that the kind of incentives from Simon with the issue of the kind of tax relief, is that still justifiable the way that works, given the pressures under lower income households now? National Unity, yes, Mike, I mean, it's a great point. It's quite frightening, but the good work of National Unity in plain numbers show that actually we can do something about that. And so this idea that people need support, it's to understand is really important.
Yeah, thank you. Nigel, your thoughts, particularly on picking your thoughts on that point, but Hilary varying the contribution rate through enrolment, and then I'll come back to Hilary's. I'll give Hilary the last word from the Institute and faculty. So,
yeah, I think one of the policy challenges is how we take auto enrolment forward from a saving level we all know is nowhere near sufficient, and how we're able to put more in on top. So those kind of like flexible enhancements to it, where you can choose to go beyond 8. You don't have to. You don't have to opt out or do the full rate. You could choose to do a bit higher or not. I think would be a sensible policy change in that situation, just to try and get people to save more with some employer backing. So that I think that those ways forward on that have to work in that situation. What other questions do we have? I mean, I think the only on pensions is the regulators going around trying to wind up all the small pension schemes because they're not actually capable of delivering the service for a decent cost that the pension that savers want. So on the old legacy DB, we're actually after fewer larger rather than more small. So I'm not entirely sure in the pension landscape we do need a lot more small schemes like that. I think what we need to do is get the ones we have performing well. And actually, I think the data shows that people need kind of fewer options. If they have more than 4 choices, people start to blow their minds and they can't cope. So I think what we should focus on is those small number of pathways that people can understand. And perhaps we don't need larger amounts in this field.
There can be such a thing as too much choice. Dangerous ideas. I mean, the final word to Hilary Salt.
So perhaps I'll bring you back to a report on the Great Risk Transfer, because one of the key points in there is around how do we explain pensions across a whole range of different products in a consistent and helpful way to members. And I think we're very happy to work with other organisations to try to take that work forward, because I think our members can really help. But I think it also needs the input from other parties who can make that message more accessible to members. On the have we over-regulated, that's my personal view. I think some of the things that we're looking at now around Solvency II and the review of that could provide perhaps scope for there to be a wider variety of providers, a real Brexit bonus, if you like. So, again, this is an area where I think actuaries can really help in those discussions, in those policy debates, and we're keen to continue that discussion.
Thank you. With that, I'm going to bring things to a close and invite you all to give a hand of thanks to all of our panel and to the Institute faculty for the report and for making this all possible. So thank you very much.